as traders, we always strive to be perfect, right? We always try to make the most amount of money out of the market, and we always try to lose the least amount of money as possible. And in my opinion, that is the most incorrect approach as traders because we can make money and be very imperfect. And it's almost like a domino effect in our trading, right? If we try to be perfect, our risk management's not going to be there. Our emotions are not going to be there if our risk management's not there. And most importantly, if those two factors are not there, we're just simply not going to follow our plan and we're not going to be following our trading system or edge. And it's a domino effect. And this was the case for me this month. And I want to go over the things that I did right, things that I did incorrectly. That way, if anybody's going through it, you're going to know how I overcame it and ended the month green. Because, like I said, it's a domino effect and it's very difficult to get out of your head psychologically if you don't know the obstacles to overcome. Now, I had a 48% win rate this month. And honestly, this is a little bit of a higher win rate than I go for. I'm more of a focus on risk to reward and R multiple than focus on win rate. Because if you have a higher average win to loss, for example, a 3R, 4R plus, that could be sacrificed for a lower win rate because at the end of the day, our job as traders is to not be as right as much as possible. It's to be as wrong as much as possible, yet still come out green and make money consistently. Now, before I break down all the trades and before I break down all the setups in terms of the technical analysis, I recommend everybody to stop what you're doing, click the link in the description below to follow me on my Instagram because on here I post daily trading recaps, along with really good trading tips and tricks that I just guarantee you're not going to find anywhere else on the internet. Again, the link for this is in the description below. You're seriously just missing out if you're not following it. So now let's break down this month in half. Let's talk about the first 2 weeks first, because this really set the tone for the following 2 weeks. And let's go over my first mistake. September 2nd, great trading session, about 19 points on the S&P 500, best profit all month. September 4th, nothing really to talk about there, but September 5th really damaged me this month, and this is a big mistake in myself and what I've seen a lot of traders do is they have one large losing day, and I attribute this to me not following my plan. One of my biggest rules in the market is after 3 losses in a row, I shut down, I call it a day, and that's usually because I'm completely wrong about the analysis and I'm just completely wrong about where I'm expecting the market to go. So after taking 3 losses, I then took a 4th trade, which is going against my rule set, which is something that you have to follow your rules. Why have rules if you're not going to follow them? And this attributed to a significantly larger loss day. In fact, this was about equivalent to my one profitable trade that I took earlier that week, and this week was about a break-even week. Now, this mentally damaged me. So me not following my rules mentally damaged my trading and took a massive hit in my confidence and then enabled me to hesitate on my future trades. Now, because of this day, right, my average risk per trade is about $4,000. This is how much I'm comfortable losing if my stop loss hits. Because of this day and because of my lack of confidence now moving forward, I lowered my risk the following week to about $2,500. Now, a big thing to my risk management and how I really attribute a lot of consistency comes from how I manage my risk. I do dynamic position sizing and static dollar amount risk, meaning my risk per trade is always going to be around the same dollar amount, which is around $4,000. And depending on how tight or wide my stop loss is, I adjust my position size. That's what I mean about dynamic position size. Now, after that, I lowered my risk to about 2.5K. The issue is that following this, I did dynamic risk and dynamic sizing. I mean, following this, I basically kept my risk the same, but kept my position size the same and put my stop loss where I was comfortable losing this dollar amount. And you're going to see why this is going to affect me in future trades. I'm going to explain that. But another thing that I want to explain about my risk management is look at my biggest dollar amount, not even profit or loss. My biggest dollar amount really came from the loss down here. And this one loss was about equivalent to my biggest gain so far that month. Now, despite this day right here, look at my losses. they are about equal to my wins. For proper risk management to get in place, right? Our losses have to be at least 2 or 3 or even 4 times smaller than our biggest or average wins, right? So let's compare now. This is September. Let's compare this to May, which was my best trading month so far this year. Look at my losses in terms of a daily P&L compared to my daily plus wins, right? My losses are not even close to my wins because my wins are at least 3x, 4x. In fact, this month I almost had a 4x average win to loss. And this is what a perfect, not even, I don't want to use the word perfect, this is what an excellent trading month should look like. And now comparing it to September. So my risk to reward really wasn't good. So because of me making an emotional mistake and me not following my rules, that made me then affect my risk management. And it lacked my confidence and took a hit in my hesitation. And now this is going to make me trade differently because now I'm going to start taking bad trading setups because my risk wasn't in play. Now this is a snippet from the Invest to Trade Academy, and I'm going to host a webinar after I record this video. And I was preparing these slides, and I think this is a very essential equation because this will help traders, including myself, avoid bad trades. And this is kind of what I wanted to implement, and I did implement in the following 2 weeks of September. Where plus when and why equals a trade. Where is the location? For me, it's supply, demand, key levels, any levels off the tape. It's giving me a location of where I want to be active, where's my level of interest to be present in the market. It's essentially, let's watch price action here. Now, the second part of this equation is when and why. So after I have my location, when and why do I need to be active? This gives me confirmation. It puts the final pieces of the puzzle together for a trade. Without both sides of the equation, my edge isn't present and I'm a spectator on the sidelines. Because what we're going to see here is a lot of trades this month. I had the where component, and we're going to be easily be able to see the bad setups. Is I had a good location. Is at a supply zone. It was at a low volume node, but I didn't have the when and why. Or my when and why was I think the market's going to go down. Or I think we're going to sell off from here because it's at a level of supply. And thinking or expecting something to occur is not a valid reason to trading, and I attribute this to a lot of my bad setups. We need to have both sides of the equation with hard evidence to give us a solid hypothesis or a valid thesis to put risk on and take the market long or short. So the first setup I want to go over was basically a good location, but me entering just based on where I want to see the market go. Now, one thing you're going to notice here is look at my risk. I stopped out of this trade for about a $2,300 loss. And you're going to see why this is so important is because once I start winning, my wins are not 3, 4x because I did not adjust my size or my risk to be better. So here we're going to see I take the market short well before my level of interest. And this is me entering because I think the market is going to head somewhere. So a very important thing that I want everybody to work on after you watch this video is even if the market hits your level of interest, or even if it's not at your level of interest, right? Do not enter because you want to see something happen. As traders, we want to see what we want to see. We want to feel what we want to feel, and we want to control what we can control. And in this example, I basically shorted the market. My level was 67.15. I shorted it well before my level just because I wanted to see the market sell off, and I took a loss on this setup, unfortunately, well before my level of interest. Now, here's a good example of great confirmation or a great when and why, but a terrible where. So in this example, again, similar risk, similar loss. The market was making all-time highs, right? And I want to show you the confirmation for this setup. The market was at all-time highs, and a very good tip that I want to give you all here, I'll go to a daily chart, is at all-time highs, there's absolutely no reason to short the market because there's zero downside pressure in the market, right? There's zero bears built into the market. There's zero supply. There's zero sellers or there's zero buyers who are going to be underwater. So when the market's making all-time highs, it's best to only look to long pullbacks, and a lower quality of a setup is going to be shorting all-time highs. Now, this is a good thing this is a good example of great confirmation, but terrible location. If the location of this was at a supply zone or the location of this was at resistance, and I get this confirmation, this is an excellent setup. So here the market was rallying, again, all-time highs. And looking at the footprint chart here, we could see the market rallying on strong, aggressive buying, right? And then all of a sudden, selling comes in. And now the book starts flipping really red, right? We start turning red, and there's a lot of selling volume coming in. There's a lot of trades hitting the bid at a high a day. To me, this is a very bearish indication as long as the market continues to drop. Now, this is a very bullish confirmation if the market continues to hold this or support it. And I can make a video on this, in fact, because this is a good playbook. It was aggressive selling but no downside is a good indication of more upside. But again, bad location because this is at all-time highs. We can see here the book really was starting to flip red, right? You can see a lot of selling coming in here. You can see a lot of low volume nodes under price and a lot of selling volume is coming in. So I was like, all right, let me try this thing short. And unfortunately, the market did not sell off. And I attribute this to having good confirmation, but a terrible location. Because later in the day, the same exact thing happened, right? This was a $3,000 loss. So this, now I held past my stop loss or held past my average risk. And the trade here was the same thing. The market was rallying towards all-time highs. And this was a little before 11 o'clock. So I could go to the replay here and go a little by 11 o'clock. Market's rallying, right? And look at all this. Look at that large aggressive selling block. And I was like, all right, let me short this. Large aggressive selling's coming in. And even looking at the footprint here, we can see the same thing, right? We can see the market rallying, aggressive selling coming in. And unfortunately, the market continues to hold this, which is a bullish indication looking back in hindsight. And I stop out of this trade for a $3,000 loss. Again, great confirmation if this is at a supply zone, but terrible confirmation if it's not at a good location. And this is going to be a significant point in my analysis here because where plus when and why equals a valid trade. Now, why it's important to keep your risk the same, right? And one of my mistakes was lowering my risk. But once I started taking winning setups and gaining the confidence back, because I never adjusted my risk higher, my wins never really outweighed the losses in terms of 3 or 4x. What I mean by that is that this was a winning trade, right? And look at the win on this. I mean, if my average loss is around $2,500, when I eventually start winning, me not adjusting my contract size properly, my win is not, it's like about 1.5x compared to my losses. So this was a win that I took on September 18th in the pre-market session of a $3,600 profit. Now what I want to get into is showing you the setup that I took on the 11th of bad location, good confirmation. This is identical here, right? This is going to be an identical setup, but now we have a good location and great confirmation here. So here now we have the market rallying up and we're at this level of supply, right? And this confirmation here around 10:20 Eastern time is identical to what that trade that I just showed you all is. So here the market rallies, right? And similar, here we could see a sign of trap buying, right? We could see a delta outlier at the high. We could see the market sell off aggressively, and we could see the selling volume build at this level of supply. Unfortunately, this trade did not work, and I stopped out of this trade for a $2,400 loss. Again, if I increased my risk, eventually when I win on the setup, my win, for example, this trade was about a 3R, 4R. My wins should have been technically a 5-figure trade, but unfortunately it wasn't because of my improper risk management. So here, the same day, I take the market short as it's rallying, and this was a little after 10:30, so I can show you all what this looks like, right? The market's at a level of supply, and as it hits this level of supply, we're going to see larger offers filled, and we're going to see the book start flipping towards the red side, right? Look at all this aggressive selling volume coming in. We're at the level of interest of at supply. Here's my original short entry that I took the loss at. And then here, the market starts selling off and aggressive selling volume comes in. And what it looks like on the footprint is identical. The market's rallying. Aggressive selling volume comes in. We can see the highest amount of selling on this bar down here where my cursor's at. And then the market continues to sell off. And I take this trade for a solid, profitable win. At my level of demand. And then this was a great setup. It was 12 points, but because of my risk wasn't where my average risk normally was, once I started winning this month, my wins were not the 3-4x how they normally should be. And this is a significant point of risk management is when I started winning, my wins were not 3-4xing it because I always lowered my risk and I did not adjust my size properly. And to validate this trade was a 4-to-1 realized risk to reward, right? Look at my risk. I was babying. I was scared. I was nervous. I didn't want to keep bleeding my account this month when I took a mental hit. This trade was a 4-to-1 R. If my risk was about average, this again would have been a 5-figure profit. This is what I call a pull and slam. This is something new that I've noticed in the market. Let me know if you guys notice the same. Right before the market opens, pull up the heat map here, we could see these two large offers appear here, right? So I'm going to mark this as a level, and I don't pay much attention to resting orders. I really don't. Resting orders don't mean much unless they're filled. But what's interesting here is these two orders that we see here for significant size on the E-minis pulled as the market was rallying into this. Despite them pulling, the market still rallies into this level and rejects it. This is why I call it pull and slam. They pulled their orders and essentially the market slams on them. And if I speed this up, we're going to see an aggressive sell-off after a clear rejection. So look, rally into this, clear rejection, and you're going to see the selling step in. Watch this. Watch all the selling build here. Right there. Look at that. That's what something you want to see when you're short. Look at that. Look at all the red. Look at all the selling volume coming in. And that's something you want to see when you're short. So that was a great setup on here. But again, because of my risk management, it didn't pay as much as it should be when I started being right on my analysis. And this is why always keep your risk the same. Always keep the risk the same. That way when you start winning, the losses are going to multiply, or the wins are going to multiply compared to your losses. And this setup was similar to the setup that I saw earlier, I showed you all earlier. Market sells off, forms a low volume node. This was right before 10:30, right? So on this sell off to the market to the downside, we have this low volume node right here. The market's going to pop into this low volume node, and watch, aggressive selling is going to come in, and I take the market short there. Right? It pops into this low volume node and then continues to sell off, and watch the selling volume come in. Watch this. And that's something you want to see again if you're short. And this is what it looks like on the footprint. Same thing, right? Pop up, leaves a P shape, aggressive selling coming in right here, and continuation down. And that's something that I like to see. And again, look at this trade, right? About a 3.4R. But because my risk was lower, right? So if I doubled my position size, which that fits my average risk, this P&L would have been doubled. And that was a big issue in my trading so far this month. So I know this was like a blend of risk management, a blend of me taking a hit in my emotions and me showing you some confirmations in a little bit of a sped up manner. But after this, I'm going to be doing the Academy webinar where we're going to break down all these bar by bar. If you have any questions, let me know in the comments. If you're new to my channel, hit that subscribe button. And be sure to check out the links in the description below to follow me on my Instagram. But I'm ending it on that note. Peace out.